On October 9, 2002, the Nasdaq hit its lowest point since the dot-com bubble began deflating. It had fallen 78% from its peak. Technology companies that had been worth billions were now worth nothing. Retirement accounts that took decades to build had been cut by more than half. Financial journalists were openly questioning whether the stock market would ever meaningfully recover. A postal worker named Gerald did something that his coworkers thought bordered on reckless. He had been quietly saving for 9 years, setting aside a fixed amount from every paycheck with the intention of eventually buying a small rental property. He had accumulated $62,000. Instead of buying the property, he put the entire amount into a total market index fund. His wife was nervous. His brother told him to wait until the economy showed clear signs of recovery. Gerald's response was simple. He said the prices looked too low to ignore. That $62,000 investment is worth approximately $780,000 today. Gerald didn't analyze individual companies. He didn't have a financial advisor. He didn't predict when the market would bottom. He simply recognized that extreme fear had pushed prices far below any rational measure of long-term value, and that this kind of moment doesn't repeat often. Most people watching this have no idea that a comparable opportunity is unfolding right now. Not a market crash this time, something with a longer timeline and a larger scale than any single market event in American history. The number at the center of it is $124 trillion. That figure represents the largest movement of wealth ever documented in human history. It will unfold over the next 2 decades. It is already in motion, and the overwhelming majority of people who will be affected by it, positively or negatively, have never heard it discussed. Today, I'm going to show you exactly what's happening, why the historical parallels to previous wealth creation events are striking, and what specific actions ordinary people are taking right now to ensure they're positioned on the right side of this transfer. The story of what happened after October 2002 is worth understanding in full because it establishes the pattern we're watching repeat. The market didn't simply recover from that bottom. It launched into a 5-year bull run that carried the S&P 500 from 776 to over 1,500 by 2007. Then, after the financial crisis created a second and deeper bottom in March 2009, the longest sustained bull market in American history began. From 2009 through early 2026, the S&P 500 rose over 900%. The index crossed 7,000 points for the first time in January 2026. A $100 invested at the 2009 bottom became roughly $1,000 17 years later. The people who accumulated most of that gain weren't professional traders or institutional investors managing complex portfolios. They were electricians, nurses, librarians, and restaurant owners who kept contributing to their 401ks and IRAs, while news coverage made continued investing feel irresponsible. The results compounded into something remarkable. In 2010, the United States had approximately 8.4 million millionaire households. By the end of 2024, that number had grown to nearly 24 million. The country added more than 15 million new millionaire households in 14 years, roughly the entire population of the greater Los Angeles area, all crossing the $1 million threshold within a single generation. According to UBS's 2025 Global Wealth Report, the United States created 379,000 new millionaires in 2024 alone, more than 1,000 new millionaires every single day. The majority of them didn't sell companies or receive stock compensation packages. They accumulated assets steadily in rising markets over years and decades. UBS categorizes this group as everyday millionaires, individuals with between 1 and 5 million in net worth. Globally, this group has quadrupled since 2000 to approximately 52 million people. The path to joining them is documented, repeatable, and about to receive significant tailwinds from a force most people have never considered. That force is the Great Wealth Transfer. According to Cerulli Associates' most recent research, from 2025, approximately $124 trillion in assets will change hands between now and 2048. This is not a projection based on optimistic assumptions. It is a demographic inevitability, the mathematical result of when the wealthiest generation in American history reaches the end of its life cycle. To put $124 trillion in perspective, it exceeds the combined annual economic output of every nation on Earth. It is more than 5 times the current U.S. national debt. It represents wealth accumulated over 8 decades of American economic expansion, now preparing to cascade through the generations in the largest single transfer ever recorded. The mechanics are straightforward, even if the implications are profound. Baby boomers, born between 1946 and 1964, currently control approximately 52% of all wealth in the United States. That's roughly $78 trillion concentrated within a single generation. The youngest boomers turn 62 this year. The oldest are approaching 80. Over the next 2 decades, this wealth will transfer to children, grandchildren, and charitable organizations. Cerulli estimates approximately $16 trillion will flow directly to heirs, with another $18 trillion directed toward charitable foundations and institutions. Generation X, often called the forgotten generation, stands to inherit approximately $39 trillion over the next 25 years, arriving at a life stage when many are simultaneously supporting aging parents and financing their own children's education. For a generation whose retirement prospects have looked uncertain, the inheritance wave could prove transformative. Millennials face a longer timeline, but a larger eventual sum. The $46 trillion heading their way will arrive as many enter peak earning years, creating compounding effects as inherited capital stacks alongside career income. Even Generation Z will begin receiving meaningful inheritances as the transfer accelerates through the 2030s and 2040s. But the critical detail that most coverage overlooks is this: the opportunity isn't primarily about receiving an inheritance. It's about what the movement of $124 trillion does to the broader economy. When wealth of this magnitude changes hands, it doesn't sit idle. It gets reinvested. It gets spent. It gets deployed into real estate, businesses, financial markets, and emerging industries. Every dollar in motion creates opportunities for people positioned to intercept some portion of that movement. The wealth transfer creates rising conditions across multiple asset classes simultaneously, not just for heirs, but for everyone participating in the economy it flows through. The last time anything structurally comparable occurred was after World War II. Returning soldiers used the GI Bill to purchase homes, launch businesses, and build the middle class that defined American economic identity for half a century. That single policy-driven wealth creation event produced the baby boomer generation, who are now transferring their accumulated wealth to their own children and grandchildren. History is completing a circle, but at a scale that dwarfs the original event. The parallels to 2002 and 2009 run deeper than they first appear. In those market bottoms, 3 conditions aligned to create extraordinary wealth for people who recognized the moment. Asset prices had been dramatically compressed by fear and forced selling. A large injection of capital was approaching through government stimulus and eventual economic recovery, and most people were either too frightened or too financially constrained to act. The current moment shares the same 3-condition structure, though the mechanism is entirely different. Markets aren't crashed. Instead, the capital injection this time isn't coming from government stimulus. It's coming from the accumulated savings of the wealthiest generation in American history, now beginning to flow to their heirs. The scale, $124 trillion, dwarfs every government stimulus program ever attempted. The entire pandemic relief effort totaled approximately $5 trillion. The wealth transfer represents 25 times that amount, deployed gradually across 2 decades. And just like those market bottoms, most people have no idea it's happening. The great wealth transfer receives a fraction of the media attention given to daily market fluctuations. Despite its impact over the next 20 years, being far more significant than any single market event. The strategies for capturing opportunity from this transfer require understanding several key dynamics. First, inheritance alone will not create most new millionaires, but that's not where the real opportunity lies anyway. Cerulli estimates that approximately 62% of the wealth being transferred originates from high net worth and ultra-high net worth households, representing only about 2% of all families. The inheritance itself is highly concentrated. A small number of families will receive transformative sums. Most families will receive modest amounts or nothing at all. The opportunity for most people isn't the inheritance. It's what the movement of $124 trillion does to asset prices, business conditions, and economic growth. When trillions flow into investment accounts, broad market values rise, benefiting everyone already invested. When heirs purchase homes, real estate appreciates, benefiting existing owners. When inherited capital funds new ventures, employment expands, benefiting workers across the economy. The transfer creates conditions that lift multiple asset classes at once, and anyone participating in those asset classes benefits from the current. Second, understanding where the money will flow provides a meaningful advantage. Research from Bank of America and Merrill Lynch shows that younger investors carry fundamentally different preferences than their boomer predecessors. 72% of investors between 21 and 43 believe it's no longer possible to achieve above-average returns through traditional stocks and bonds alone. This represents a generational shift in investment philosophy that will redirect trillions of dollars across asset classes. Where boomers favored blue-chip equities and government bonds, their heirs show stronger preferences for direct company investments, alternative assets, and emerging sectors. Artificial intelligence infrastructure is already capturing enormous capital in 2026. Clean energy, healthcare innovation, and digital infrastructure are positioned to receive disproportionate inflows as trillions transfer to investors with different priorities than the generation before them. This doesn't mean abandoning traditional diversified investing. It means understanding that capital flows are shifting in predictable directions, and that sectors aligned with younger investor preferences will likely see sustained inflows throughout the transfer period. Third, real estate positioning will prove consequential over the transfer timeline. The Great Wealth Transfer will reshape housing markets in ways that vary sharply by geography. Demand will increase as newly wealthy heirs seek to purchase homes. Supply will simultaneously increase as inherited properties enter the market. These dynamics will not balance evenly across all locations. Markets where boomers concentrated, suburban retirement destinations, Sunbelt communities, legacy metro areas, may see meaningful inventory increases that moderate price growth. Markets where younger generations want to live, technology corridors, mid-sized cities with strong employment, university towns with growing industries, may face intensified competition as newly capitalized millennials pursue homeownership in earnest. Median home prices have risen over 150% since 2000, but that appreciation has been geographically concentrated. Markets attracting younger workers and technology investment have dramatically outpaced markets losing population. The same capital deployed in Nashville versus a declining Rust Belt market will produce fundamentally different outcomes over the next 2 decades. Geographic awareness translates directly into wealth accumulation decisions for anyone flexible about where they live or invest. Fourth, staying consistently invested through the transfer period remains the most reliable wealth-building strategy. Gerald, the postal worker who invested $62,000 at the 2002 market bottom, didn't employ a sophisticated strategy. He needed exactly 2 things: capital available to deploy and the psychological discipline to remain invested through subsequent volatility. The market's historical average annual return has been approximately 10% over long periods. Someone who invested $500 monthly in a broad market index fund starting in 2009 would have accumulated over $250,000 by early 2026. Not including any employer match. But that journey included genuinely terrifying episodes: the European sovereign debt crisis of 2011, The government shutdown of 2013, the trade war of 2018, the pandemic collapse of 2020, the bear market of 2022. The best single days typically occur during the most volatile periods, when fear is at its highest and the temptation to exit the market is strongest. The great wealth transfer will not unfold smoothly. Recessions will interrupt it. Corrections will create temporary panic. Each episode will generate headlines, suggesting the old patterns no longer apply. History indicates those warnings will prove premature, just as they consistently did between 2009 and 2026. The underlying force, $124 trillion, seeking productive deployment, will continue generating opportunity regardless of short-term disruptions. Fifth, professions and businesses serving wealth in motion will see sustained expansion throughout the transfer period. When $124 trillion changes hands, entire industries grow to facilitate and manage the movement. Estate attorneys, financial planners, tax advisors, trust administrators, wealth managers, and real estate professionals will all see robust demand throughout the transfer timeline. People who develop expertise in these areas, whether through career transitions or complementary skills built alongside existing careers, will find durable employment and business opportunities for decades. The numbers already reflect the shift. The share of millennial and Gen Z clients at high net worth focused financial firms grew from just 8% in 2021 to 25% by 2024. Advisors who understand younger clients' preferences and communication styles are capturing business relationships that will compound in value for 30 years. Sixth, the spousal transfer dynamic that precedes intergenerational transfers creates its own distinct opportunity. Cerulli estimates that approximately $54 trillion will first pass to surviving spouses before eventually moving to the next generation. Nearly $40 trillion of those spousal transfers will go to widowed women, creating the largest concentration of newly wealth-controlling individuals in American history. Financial services, advisors, planners, and wealth managers who develop genuine expertise serving this demographic will capture significant and growing business as women become primary controllers of unprecedented wealth at a scale the industry has never previously encountered. The compounding math makes the stakes concrete. Consider a 38-year-old today who invests $600 monthly in diversified index funds for the next 25 years, roughly the full duration of the Great Wealth Transfer. At the historical average return of 10% annually, that $180,000 in contributions becomes approximately $795,000. At a more conservative 7%, approximately $486,000. The potential tailwind from the wealth transfer meaningfully shifts these projections. If economic growth runs even 1 percentage point above historical averages due to the sustained deployment of transferred capital, outcomes shift significantly. A 7% return environment becomes 8%. The $486,000 becomes approximately $567,000. Increase the monthly contribution to $1,000, achievable for many as careers mature, and the numbers scale proportionally. At 10% over 25 years, the accumulation reaches $1.33 million. Regular people reach millionaire status through consistency alone, without inheritance, without investment genius, without a single exceptional decision. The Great Wealth Transfer doesn't create this outcome. It makes it more likely by creating economic conditions that support sustained asset appreciation throughout the period when these contributions are compounding most powerfully. What people consistently overlook about wealth creation events is how they feel from the inside while they're happening. The years following 2002 and 2009 didn't feel like golden opportunities while they were unfolding. Each year brought new reasons for concern. Each crisis produced authoritative predictions that the expansion was ending. The market crossed 10,000 points on the Dow in 2010, and commentators warned it couldn't hold. It crossed 15,000 in 2013, and analysts explained why a correction was overdue. It crossed 20,000 in 2017, 30,000 in 2020, 40,000 in 2024. Those who stayed invested accumulated wealth at every stage. Those who retreated to safety at each moment of anxiety missed the compounding that followed. The same pattern will characterize the wealth transfer period. The transfer spans 25 years. It will include multiple recessions, at least several bear markets, and numerous periods where the dominant narrative suggests that staying invested is the wrong choice. The underlying force, $124 trillion, seeking productive deployment, will continue regardless. Goldman Sachs research confirms the cost of anxiety-driven decisions. Missing the 10 best market days since 2009 reduces returns from approximately 17% annually to approximately 12%. Missing the 25 best days cuts returns nearly in half. Those best days occur when fear is greatest. The investors who captured them weren't braver or smarter than those who didn't. They simply had systems that kept them invested when their instincts argued for caution. Historical context places this moment in proper perspective. The United States has experienced a small number of wealth creation events that transformed ordinary people into millionaires at scale. The post-Civil War industrial expansion created the first generation of American millionaires, though this was concentrated heavily among industrialists and financiers. By 1900, the country held approximately 4,000 to 5,000 millionaires total. The post-World War II boom created the first mass millionaire class through housing appreciation, expanded stock market participation, and pension systems. Average home prices have risen approximately 500% since the early 1980s, when boomers were forming their first households. The bull market from 1982 through 2000 created millions more millionaires as 401k participation expanded and technology stocks generated historic returns. The S&P 500 rose nearly 3,000% over that period. The recovery from 2009 through 2026 nearly tripled the number of millionaire households as markets reached successive new highs. The index crossing 7,000 in January 2026 marked another milestone in this ongoing expansion. Each of these events created millionaires who simply showed up, who participated in economic expansion without special knowledge, without connections, without anything beyond consistent presence. No genius required, no insider access, just patience and participation. The Great Wealth Transfer is the next chapter. $124 trillion will move over 25 years. Economic activity will accelerate. Asset prices will be supported by sustained capital deployment. Opportunities will emerge across multiple sectors and geographies. The question was never whether this would happen. It's already happening. The question is whether you'll be positioned when it reaches full force. An action framework based on this research includes several concrete steps. Maximize tax-advantaged accounts. The $124 trillion transfer will be partially captured by people whose retirement accounts grow alongside the economic expansion it creates. Max out your 401k. The 2026 contribution limit is $23,500, with an additional $7,500 catch-up contribution available for those 50 and older. Max out your IRA. Use an HSA if eligible. These accounts allow wealth to compound without annual tax drag, reducing the outcome. Don't attempt to identify which specific sectors will benefit most from the transfer. Own the entire market through low-cost index funds. As transferred wealth flows into various investment categories, broad exposure ensures participation in aggregate growth without requiring accurate sector prediction. Develop skills that serve capital in motion. Understanding estate planning, financial advisory, real estate, or wealth management creates opportunities to earn from the transfer itself, capturing fees and professional income from capital that is moving regardless of whether you participate in managing it. Build a cash reserve for opportunistic deployment. The transfer period will include dislocations, moments when assets are temporarily underpriced due to forced estate liquidations or market disruptions. Having capital available when others are forced to sell has historically provided enhanced entry points. Extend your time horizon deliberately. The transfer spans 25 years. Position accordingly. Quarterly market movements are noise relative to the signal of $124 trillion in motion over 2 decades. Consider geographic positioning. If you have flexibility about where you live or invest in real estate, research which markets are positioned to receive capital versus disperse it. Real estate in markets attracting younger, wealthier residents may significantly outperform over the transfer period. Have direct conversations with your family, understanding what wealth may or may not transfer to you, and what you may want to transfer to others, allows for planning that is otherwise impossible. Proper estate planning on both sides of any transfer ensures capital moves efficiently, rather than being consumed by taxes and legal complications. The timing question surfaces in every conversation about long-term investing. People want to know the optimal entry point, as if there is a moment of clarity they're waiting for before committing. In 2002, nobody knew the market had bottomed. In March 2009, nobody knew the longest bull market in history was beginning. The bottom was only obvious in retrospect, from a safe distance of years. The great wealth transfer has no bottom to time. It is a 25-year process that is already well underway. The oldest baby boomers are 79 in 2026. Transfers are occurring right now, today, in real time. Waiting for a cleaner entry point means missing years of compounding while capital continues flowing. The best time to plant a tree was 20 years ago. The second best time is now. What strikes me most about both the 2002 opportunity and the current moment is how completely public the information is. No privileged access is required. The market conditions of 2002 were visible to anyone with a brokerage account, and the willingness to look past the fear. The $124 trillion transfer is documented in research reports available to anyone willing to read them. Yet in both cases, the majority of people failed to act. In 2002 and 2009, fear prevented action. Today, short-term distraction and the difficulty of thinking in multi-decade timeframes prevent most people from positioning for an event that will shape the financial landscape of the next quarter century. The people who became millionaires after 2002 and 2009 were not exceptional. They were simply willing to act on information that everyone had equal access to. The same will be true of those who benefit most from the great wealth transfer. Gerald, the postal worker who moved $62,000 from a planned real estate purchase into a total market index fund in October 2002, didn't know he was capturing a generational opportunity. He knew prices looked unreasonably low given long-term economic fundamentals. He knew fear had created a discount that rational analysis couldn't justify. He acted on what he could see, rather than on what he couldn't predict. The opportunity today is different in its mechanism. The scale is larger, the timeline is longer. The forces driving it are demographic rather than cyclical, but the fundamental dynamic is identical. Trillions of dollars are moving. Millions of new millionaires will be created from that movement. History will record this period as one of the defining wealth creation events in American economic history. Alongside the industrial expansion, the post-war boom, the 1980s bull market, and the recovery from 2009, you now know it's happening. You know the number, you know the timeline, you know the strategies that position ordinary people to benefit from extraordinary capital movement. What you do with that knowledge will determine whether you look back on this decade as the moment you recognized the opportunity or the moment you watched it pass.